through now. But let's discuss the fundamentals of this market. We have Siddarth Bhamre joining us. He's head of research at Religare Broking. Siddarth, thanks a lot for joining us today on the show. We do want to discuss a lot of individual stocks, so I'll get to that in just a bit. But first up, we're mostly done with the Q1 earnings season. So how do you really see how the season has panned out and your outlook for the market from here on?
Good morning, Pavitra. Thank you for inviting me on your show. Well, earnings has been decent. Different sectors, different outlook. But then only worrying factor is the pace of earnings is not as fast as the pace at which market had gone up in last 3-4 months. So last time also on your show, we mentioned that we are not very comfortable with market purely from devaluation perspective, and that stance remains. As far as earnings are concerned, I think banking was pretty decent with advances growing at healthy pace. Though some of the private sector banks we have seen NIMs coming down and some provisions going up. Interestingly, SBI reduced its provision, but the advances growth rate was pretty encouraging. Some of the heavyweights didn't do pretty well, but then I think that's part and parcel of the industry they are into. IT gave initial scare, but then interesting part with IT is that when the growth and visibility, when growth visibility was there, that time earnings support was not there. And now when there is a lot of murkiness in terms of near-term visibility, the valuation support is very strong for IT. So IT earnings were not very impressive, but if you look at stock performances, they have not been that bad after what Infosys and other major companies had to say about earnings growth and revision of guidance downwards. We did see, decent numbers coming from auto space. There has been, a lot of margin expansion in that space. Even some of the FMCG space where decline in crude oil prices have helped companies post decent margins. So there's nothing to complain as such a broad base in earnings. Only thing is that it's not justifying the valuations which markets are trading. Good part of good earnings, despite high valuations, is that your cushion, earnings give you cushion to this market. That cushion keeps on increasing. So I think we are on a good path, and earnings would ensure, this kind of earnings ensures that if and when market corrects, those corrections may not be deep. That's what we are reading out of these earnings.
Okay, so not expecting too much of a deep correction. That's the read-through. Siddarth, hi, good morning. Let's get down to some of the interesting house calls. And we were poring over that note that you had shared with us, and some of the views really stood out. And I want to pick up on the auto side of it first, because you seem to have buy calls, on a lot of stocks, including the likes of, I think, Bajaj, even Hero, if I'm not mistaken. And we're in very interesting times. Maruti, on one hand, is really revving up with the SUV battle. And then there is this battle of the premium bikes. Just see what Hero is doing today on the numbers that they released. So what's your thought on both of these two stocks? And what's the premise from here on, Hero Moto as well as Maruti?
Yeah, so Hero we are not covering in detail, but I would like to comment on what's happening in two-wheeler space. But Maruti, I would we are very optimistic on Maruti. We all know the story that, the market shares came down in last 10 years or so because of competition creeping in. But then now the interesting part is the way a company is positioning itself. Recently, it launched, the most expensive car among its space, though I don't know how many numbers would flow in there. But the product profiling is changing for Maruti Suzuki. And we are seeing a result of that as margin expansion. In fact, utility vehicles earlier used to constitute around 17% of overall volumes. It has gone up to 25%. Utility vehicles means higher, tech price, which means higher margins. And that's the reason you're seeing there is a decent expansion in margins. At the same time, even volume growth. And at 23, 24 PE, Maruti is really cheap at these levels. We have aggressive target price of 11,500. From current levels, and we are suggesting to our clients to buy the stock right from 8,000 odd levels, and we still are mentioning them to add on and hold on to if they have purchased before. Two-wheeler space, I think a lot of noise we have heard over here about big launches, premium launches, and that has affected some of the market participants. But more than Hero, I think we are liking Eicher Motor at this point of time. Here too, a lot of people feel that, it would start losing its market share. I think announcing Hero and Bajaj announcing their tie-ups is one thing, and actually building that capacity and eating up market share, it takes time. It doesn't happen immediately. And we have seen that Eicher Motor has adapted pretty well to these kind of competition, not of this nature, but earlier also there was a scare of Java launching some of the bikes which Enfield has strong market share. So we are not too perturbed because of this. And again, let me tell you, Eicher at 24-25 PE is available at cheapest what it was trading in last 6-7 years. So here too, valuation support is there, though, there is competition which is creeping in. So one line I want to state here, which I keep often stating is, if you are getting earning visibility and growth, then you won't get valuation. But if you're getting, valuation, then you won't have earning visibility. So you have to take a call. And right now, Eicher Motor falls into that place where there is a good valuation support and earning visibility is also not that murky. So Maruti and Eicher Motors from Autospace.
Okay, so Eicher Motors valuations are the lowest that we've seen in the last 6 to 7 years, which is why it makes a compelling buy according to you. Your target price is at 4,200 plus, and the stock is currently at 3,300. So you're looking at a big upside. Siddarth, unfortunately, we're out of time. Thank you very much for joining in. Get into a break. We'll come back with more.